Welcome to the India Growth Mission. I'm Tamanna Inamdar. This week we're going to be speaking about a phenomenon that policymakers, economists and businesses around the world are preparing for. It is the regime of hiked interest rates. Now, it's obviously kick-started with an announcement that the Federal Reserve in the United States has made that they're going to begin the end of their quantitative easing program and rates will have to go up, interest rates will have to go up. This is being pushed largely by inflation, which is at several decade highs in the United States. But it's across the world. We're seeing the European Central Bank face that pressure. Bank of England has already hiked its rates, and all eyes are on what India's central bank, the Reserve Bank of India, will do this week after their MPC, their Monetary Policy Committee, meets and makes a decision. Now, the time is ripe, I guess, for a rate hike. Inflation is a problem that everyone is facing. Remember, central banks around the world had pumped in money into the system to really protect growth and protect their individual economies, which was hit by the pandemic. As those numbers are easing, as the world is returning to some sort of normalization, is a time to start pulling back the reins. That truly is the question we're asking our panel today. We're also going to ask them what it means if you have to start hiking rates at a time when the Indian economy is still in recovery mode. So we'll get to our panel. First, though, let me go across to my colleague Ankur Mishra, who is telling us what the ET poll says on what we can expect from the Monetary Policy Committee.
Just a few hours to go for RBI's monetary policy, and we have done a poll to understand what are going to be the expectations from the policy. The first question we asked was that what is going to be the repo rate expectations this time, and 100% respondents have said that status quo is expected this time. The second question we asked was that what are the repo rate expectations this time, and it is an expectation this time there is going to be a slight increase in the repo rate, and therefore 80% respondents have said that repo rate might be hiked this time. And then last question we asked from the respondents was that what is going to be the key expectation from the policy in terms of stance. Everybody has said that it is going to be an accommodative stance, while there will be biasness towards a hawkish tone. The other key expectation is that reverse repo rate, the quantum will be 15 to 40 basis points. Apart from that, MPC may continue the focus on growth this time. Apart from that, they are likely to kickstart the normalization. Remember, last time there was an indication, but it was not actually done from RBI. Or this time the expectation is that they might prepare the market for a rate hike, which may happen in later future. As far as the factors to watch is concerned, the important thing will be watch out to the commentary on the economic recovery and Omicron impact, how the recovery has been, and has the impact of Omicron completely faded away. What are going to be the GDP target revisions after Union Budget has said that 9.2% GDP is expected for FY22. Apart from that, the comments on inflation trajectory will be important, because the RBI governor had earlier said that after March this year, the inflation may start coming down. Another important thing is that what is going to be the stance, actual commentary from RBI, whether it is going to be accommodative stance or it is preparing for the hawkish tone to the market. And last but not the least, the liquidity management amidst surplus liquidity being in the system, how RBI is going to watch this time and how it is going to prepare the market for that. And there is one more important thing, that is central bank digital currency. How soon it reaches from the Reserve Bank of India to your e-wallet, it will be seen in this RBI's credit policy.
All right, joining me now is Aditi Nayar, Chief Economist at ICRA, Siddharth Sanyal, Chief Economist and Head Research at Bandhan Bank, and pleased to welcome Anubhuti Sahai, Head South Asia Economic Research, Standard Chartered Bank. Welcome to all of you, and thank you so much for speaking with us right here on ET Now. Aditi, let me begin by getting your overview, and of course the simple basic question is, what do you think Governor Das will announce this week?
Thanks, Tamanna. So our view is that this is going to be the last status quo policy where on the downside now of the third wave of COVID-19 in India, it spiked quickly and it's abating quickly as well. The disruption has not been too the restrictions that were required to combat the third wave have not been too disruptive. But at the same time, there is some amount of lingering uncertainty on the growth and the confidence front. And therefore, we believe that this is going to be one final policy that is going to prioritize growth over inflation, given the fact that our inflation medium-term target band is pretty high and wide at 2 to 6%. So we're not expecting any change in the stance or in the reverse repo rate this time around, but we expect policy normalization to kick off from April.
Okay. Ms. Sahai, do you agree with that position that we'll see largely the last status quo policy, perhaps with a slight tinkering with the reverse repo, mostly bringing it back to normal?
Yeah, I would agree with that. In terms of our projection, we are looking at a reverse repo rate increase of 25 basis points. But as far as repo rate is concerned and accommodative stance is concerned, we think that the Monetary Policy Committee would retain would maintain a status quo on that. When we move from an ultra-accommodative monetary policy towards policy normalization, given the history of RBI, our sense is that the move would be very calibrated. The first step would come in terms of reverse repo rate increase to build in that expectation around timing of the repo rate increase eventually, and that would happen in our view on Feb 10th. And probably in the April or the June policy meeting, we can see a shift from accommodative to neutral and then a repo rate hike in either June or August. Our baseline view is that repo rate increases would begin in August, not before that. But if inflation risks persist, then probably it can get advanced to June.
Mr. Nayar, I want to ask you about how inflation is being perceived right now. And while the world over it is a big issue, in India it is often looked at as not such a big problem yet. We're still in the tolerance band of the RBI. Does it still warrant some action down the line?
Well, one cannot take it very lightly, because you are right that it's within the RBI's tolerance band. And if I try to see compared to the target or target band where it is today in the case of, say, US, which is a multi-decade high, compared to that, India's inflation spike so far has been far less damaging. But at the same time, it has been proven time and again over the course of the last about 18 months that whenever there is some disruption so far as new waves of COVID or for some other we have witnessed, there had been very significant supply side disruption, logistic related disruption in a very significant scale, and that has been persisting in some way or other for a pretty long period of time. So as a result, what is happening, the inflationary pressures, even though that's not in sync with the exact demand side condition, is persisting across the world for a pretty long time. So in our case also, most probably going ahead over the next few months, we might see spells of inflation spiking higher off and on rather than enjoying a relatively benign patch.
Now the question is, what will be the impact of an imminent rate hike if it doesn't come in this policy, possibly in the next? And we know the direction that we're inching towards largely, which is following what the world is doing. But let me bring this to Aditi first. Looking at our specific context, where we are an economy which is still recovering, which continues to need support, how far can Governor Das go with the whole rate hike?
Sure. So, Tamanna, our view is that we're going to get a, status quo on the stance as well as on the reverse repo rate in the February policy review. And the reason that we believe that we're going to get the stance and the reverse repo rate hike together in the April review and not now is that, we've already seen in the last 2 weeks, rather in the last week or so, after the budget was announced, yields spiked up because the government borrowing program for FY23 is higher than what the market had penciled in. And there weren't really too many concrete updates as far as the bond index inclusion is concerned. After that, last Friday, we saw a large part of the auction being cancelled. And in fact, for this Friday, based on a review of the cash balances of the government, the auction has been cancelled altogether. So our view is that a reverse repo hike at this point will only serve the purpose of further pushing up yields. Already the repo rate is pretty much the operative rate. The reverse repo rate hike is not really going to change that right now. So we're not expecting that signaling to come at this policy review. We're expecting it to come together at the next policy review. And, in terms of going back to growth, what we're seeing in the Q3 numbers, we believe there's a bit of a broad basing of the economic recovery, but the durability criteria definitely is not being met. The capex commitments that Government of India has made in the budget are a very good step and, very welcome. But we do need to see how quickly that spending actually takes off. Now, on the inflation side, in this quarter, we believe that we're going to be right at that upper edge of the inflation target band. We're expecting to see prints between 5.7 and 6%. So it's only a matter of time before we have to get that signal from the MPC that inflation is back on the forefront, which we expect in April. And we expect to see 2 repo rate hikes of 25 basis points each in June and in August. So kick off earlier than what Aditi had mentioned.
I want to come to the question of impact. Mr. Sanyal, usually markets, companies, investors look at possible rate hikes with great trepidation. Do you think there will be a significant impact in India where we're still waiting for private investment to kick in, where we're still waiting for the economy to recover fully?
Yes, there are actually 2 to 3 aspects to it. One is related to private consumption, another one is capex, and the third part is possibly markets. Now, in all the areas, there can be significant repercussions to an interest rate hike at this juncture, and I would like to highlight that we also do not think that in this particular policy we will see any rate hikes. Now, going back to this particular 3 blocks. We have seen a prolonged phase of very, very subdued consumer confidence for a very long period of time during COVID. We have seen in the pre-Omicron days, the consumer confidence just started moving a tad higher, but any uptick in interest rates in general, especially in case of in the segments of durables, housing, etc., might actually do some kind of put a bit of a brake on the recovery on the consumer sentiment, consumer confidence, and overall private consumption spends. And that is something which is true in case of private capex also, because private capex, it's at a juncture where the recovery has just taken shape. So not necessarily a lot of corporates will be jumping into action. Straight away they will possibly try to be pretty nuanced about making their fresh investments. So at this juncture, if interest rates start going higher in a hurry, that will actually be somewhat damaging. So our sense is that the RBI will take that into account. RBI had always been followed a very calibrated and nuanced approach. And the third part is definitely the market part. And there, if you see, the government borrowing in this particular budget had been slightly higher than what was being possibly factored in by the market, and there is very clearly a bit of upside pressure on the yields. The RBI will be mindful about managing the yields also as the government's debt manager. So our sense is that the RBI will remain very calibrated, very nuanced. And the other part here is, compared to some of the other countries which had actually delivered rate cuts in a rush in 2020, RBI's approach at that point of time was very nuanced. So at this time, the urgency or the pressure on RBI to hike rates back is relatively less. They should utilize that particular space.
So my question to you, Ms. Sahai, is that what are the weapons of choice at the RBI's disposal, considering that their consistent message has been that they want to support growth as the economy recovers, but they are faced with the same challenges that all central bankers are, to reduce the amount of liquidity now in the system as the pandemic fears start receding?
Sure, Tamanna. I think, before I get on to that question, just a couple of points with respect to your previous questions. When it comes to rate normalization, that's inevitable in India. It's true that recovery in India is at a nascent stage, but it's equally true that we are no more in an emergency situation, which was the case in 2020. Hence, we need to move away from an ultra-low repo rate of 4%. And that's also needed because RBI, like any other central bank, will need to reserve ammunition for any future crisis. On your question about whether it will have an impact on economic recovery, possibly yes, to some extent it can have an impact on sentiments, but at the same time, once this uncertainty on rate increases is behind us and hopefully inflation is under control, again establishing MPC's credibility on inflation management, I think from a medium-term growth perspective, it bodes well. So we need to look at rate normalization in that broader context.
Absolutely. It's going to be a tough balancing act, no doubt, for the MPC, for the Reserve Bank. But the larger story over here is the theme of normalization. Rate normalizations coming at a time as a tool to combat inflation while continuing to give the support for growth that is required as we recover from a pandemic.